The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is tax season. And so many of you have asked, why don't you guys do a show that's longer than a half hour? And I got to tell you, it must have worked because we're on our new time from 3 to 4 every Saturday. So that gives us extra time to help you with your taxes and your tax situation. So if you want to become part of this show, our phone number is 8030930, 8030930, star 930 in a cell phone. And I got Stevie Jacobson with me. Steve?
My God, Esther, it's like my clock is off today. I feel like it's 3:30, but it's not 3:30.
Oh, we were at training this afternoon, and I thought, I got an extra hour before I have to get over to the station. I thought, oh, no, it's at 3 now.
I know. We had to hustle over here right away.
Right. So, and Chris Fabian and Tiffany Fabian are still doing our training because we have all of our brand new not our new supervisors, but we have supervisor training so that everybody gets ready for tax season. And officially, our branch offices open up on January 16th. And the first day of e-filing?
The 22nd of January.
Right. So, and we're going to get you so that we're going to explain everything that happened in the American Taxpayer Relief Act that just happened last week, so you know how it affects you. We're going to talk about Obamacare. We're going to talk about changes to this year's tax return, things that you should be looking out for as you're thinking about 2012's returns, 2013 and 2014, because this year in 2013 is the beginning of the Affordable Health Care Act. And so we want to get you ahead of the curve so that next year when you're filing your return, you don't end up with penalties. And that will actually be 2015. But it's because of something you didn't do in 2014. Right. You don't end up with penalties because you didn't get insurance. And we're going to tell you where you can get insurance. And we're going to talk to you about the refundable portion of the Health Care Act. And so hopefully we're going to give you all kinds of information. As we go into the tax season and everybody starts putting their game faces on for filing their returns, if you have any questions, you can get us during the week at our corporate headquarters at 632-7886. You can get us online at egtax.com, or you can call every Saturday here live between 3 and 4, or on AM Buffalo, right?
That's right, every Friday.
On AM Buffalo, we're on every Friday, and you can ask your tax questions live. So we hope we give you information that you're going to find helpful.
And I think we definitely will, because there's just so much out there, Esther.
Is. So we're going to go right off right off the ball here. 8030930, 8030930, star 930 in a cell phone. Love to have you be part of the show, but let's go over the American Taxpayer Relief Act, which is also known as the non-fiscal cliff, what they did to fix it. First of all, tax rates were going to go up. They were going to double.
Yeah.
And they stayed the same.
Yep. It was going to be where 10 was going to go to 15, and there was going to be no more 15% bracket. 10 was going to go to 15, and then 25 was going to go up to 28. It was a really big hit for everybody.
So they did keep the tax rates the same unless you make $400,000 if you're single, $450,000 if you're filing a joint return. By the way, I know not everybody in Buffalo has that kind of income, but I will tell you, two single people living in the same household, be it boyfriend, girlfriend, could make up to $800,000 and still be at the lower rate. But a couple working, making $450,000 would pay at the higher rate as soon as they get the $450,000. So you can see the marriage penalty in there.
Yeah, it's I call it the pseudo marriage penalty because it really is a marriage penalty. But when you hear marriage penalty, everybody's thinking, well, standard deductions wouldn't have been doubled. Married standard deduction wouldn't be double a single. It would have been 1.5 times. There's that confusion there. But it really is a marriage penalty, and people aren't addressing that.
And a lot of the phase-outs that they kept in, I mean, they kept old things in, but as the phase-outs happen, married people hit the phase-out at a faster percentage than a single person would be.
It's a
based
very,
upon
very big
income.
deal.
And something I wanted to get at, because I know many people called us during the year. One gentleman wanted to contribute the $100,000 to a charity out of his IRA.
Yep.
And we told them that it was dead. They wouldn't allow it. But that's something they snuck in last week. You have till February the 1st, sir, if you're listening, to take your up to $100,000 out of your IRA and give it to a charity.
Yep.
And you can still do it without it being taxable. So that they did put in, and it goes through 2013.
And how many people do we know that like to do that with their RMDs so that they don't have to pay tax on their required minimum distributions? I mean, that's such a big deal, because I've had a couple clients that used to do that, and this year they had to pay the tax on it, and there were a couple people that like to do that just because they didn't want to deal with the taxability
so
of it.
that is in the law through
Right.
213, and for 212 you can still do it up till February the February the 1st. All right. The other thing is capital gains and dividends. If you're somebody that has taken advantage of the 0% cap gains rate, we're happy to say 15% bracket or under, still 0%.
I know, and that's such a huge deal because, I know we were telling people you could sell, buy back stock, but, the whole thing was we didn't know what they were going to do.
Right.
But
even if they did sell and buy it back,
Right.
they have a higher basis. So.
Exactly.
But again, the higher income people are going to pay up to, again, at the 400 and 450 threshold, they're going to pay at the 20%.
20%.
Right. And on investments, on those higher income people, 200 to 250, they're going to pay an additional 3.8% on the investments. All right?
3.8%, correct.
Right. And if they have income from wages of 2 to 250, they're going to pay a 0.9%
on the Medicare
tax.
Yep.
Okay. And that's in 2013. Permanent AMT relief. I'm so thrilled to tell you that 70% of everybody was going to get hit with AMT. But it is permanent. We don't have to worry about it. Are they going to patch it? It is permanent that they have patched alternative minimum tax.
And that's such a big deal because every year it would be like you're holding on to your seats, praying to God that they get this thing in for the year. And now we don't have to worry about that anymore. And it's going to keep going up with inflation, which is a great thing.
Well, we got people waiting, and I'm going to go back to some of these changes, but I don't want to make people wait too long. 8030930, 8030930, star 930 on a cell phone. And we have Dick in Amherst. Hey, Dick, how can I help you?
Look at the menu thing.
Hey.
If I do that,
Maybe you
Never
should
mind,
turn.
don't talk.
How can we help you, Dick?
Hello?
Hello, sir.
Yes.
How can we help you?
Hello?
Can we help you, Dick?
Yes. Could you tell me how the Roth thing works?
Well, like what aspect of it?
Well, you just deposited with the person that you work for, right?
All right. So, are you a working person?
Yes, I'm working.
Okay, and you're contributing through your employer to a pension plan?
Pardon?
Are you contributing through your employer to a pension plan? Or do you have your own IRA?
Phone of mine, I can hardly hear you.
Oh, I'm so sorry. Well, let me see if I can. Well, maybe what you want to do is hang up, and I'll explain the Roth IRA over the air. Okay. All right. Thanks, Dick. Anyway, if he is working for somebody and he has a pension plan, he can designate that to go into a Roth type pension plan, which would be not deductible now, but not taxable later on.
Right.
But if he is working for somebody who doesn't have a qualified pension plan and he's over the age of 70 and a half, unfortunately, he couldn't contribute to a traditional IRA anymore.
No, because at that point in the game, they don't let you do it anymore. But maybe he's asking about the Roth because of that
But the
feature.
Roth would still be deductible. So he could put, it sounded like he was over the age of 50. Mm-hmm. He'd be able to put $6,000 into a Roth up to $6,000 if that's what his wages were. So, but of course you would get no deduction for it. That's how a Roth works. A traditional IRA would be once you're age 70 and a half, you can't make a contribution anymore. But under 70 and a half, if you have wages, you can have from age 50 to 70 and a half, you can put up to $6,000, your wages up to $6,000, and for yourself and your spouse, if you have a non-working
and it's an
spouse.
adjustment to income, and then when you go to take it out someday, you pay the tax on it.
That's exactly right. So hopefully that answered his question. I'm Esther Gullius, the tax lady. I know if you're tuning in now, you're saying, I don't understand. She's not supposed to be on now. Well, good news. We're on from 3 to 4 from now on to answer your tax questions. And if you want to join us here in studio, our phone number is 8030930, 8030930, star 930 on a cell phone. And we're going to go to Janice in Buffalo. Hi, Jan. How can we help you?
Yes, I have a question for you. I'm working full-time, and I'm also collecting full Social Security. Mm-hmm. Now, what are my tax implications going to be for 2012?
So let's ask you some questions. Are you married?
No.
All right, so you're a single woman. Your age?
66.
Okay. Wages are approximately?
Under the limit of 38,000.
Okay, but how much are your wages approximately?
Approximately 36,000.
All right, and do you have any interest, dividends, other pension plans, any other source of income besides the Social Security?
No.
All right, so because you're single and you're getting Social Security and your total income, including half of your Social Security, exceeds $25,000, you're going to find that your Social Security is going to be up to half taxable or up to 85% taxable, depending upon what that total figure is. So,
wow.
And so if you're in the 15% bracket, and that's what it sounds like it'll be, and you end up, how much is your Social Security?
Let's see, it's approximately $1,200 a month.
Okay, so about $14,000 a year.
Yep.
Right. So 6 down, 1343, 25. Yeah. So you're going to end up with about most of your Social Security, about $8,000 of your Social Security being taxable at 15% means it'll cost you about $1,200 in federal taxes, but nothing on New York State.
Now, is that beyond the taxes on my working income?
That's correct.
Or is that the total?
No, that will be the taxes, approximate taxes on your Social Security portion.
Okay.
So what you might want to do.
Will that be true in 2013 also?
Yes, that didn't change.
And what you may want to do is you may want to have some withholding going on throughout the year,
right.
because you don't want to get hit with an estimated penalty for owing over $1,000. So
right. So what you might want to do is just tell them take out $100 a month.
Oh, there's a penalty if you don't have it withdrawn?
if you don't have the withholding throughout the year because the IRS wants their money throughout the year, then yes, there would be a penalty for owing more than $1,000, which you would in this case. Yeah.
Wow.
Right. Well, not
or potentially.
Potentially. Because if you had enough withheld out of your paycheck, and even though your Social Security might cost $1,200 in taxes, if you have enough itemized deductions and other forms of withholding, you may not owe that. And I guess the best way to for us to go into more detail is if you want to call the office on Monday and ask for Steve or Chris or myself or Tiffany, we can go over all your withholding, your year-end pay stub, and we'll tell you how it'll work out. But Steve is right. If you owe more than $1,000 and this your liability this year is more than last year and you didn't have enough withheld, they can penalize you.
Would it, even if I took out an IRA?
Well, again,
put money into an IRA.
See, that would be a great tax
Absolutely,
planning loan,
it would be.
because then you'll end up with $6,000 on the left hand, maybe $9,000 on the right hand. The one will offset the other, and that'll really help.
Oh, okay.
All depends.
But make sure it's a traditional IRA, because if you put it in a Roth, it won't work.
All right.
Okay?
Thank you.
Thanks, Janice. Bye-bye. Happy New Year. And that's, there's so, with taxes, it's like if you breathe hard on Tuesday, it's tax deductible, but on Wednesday, it's not going to be. So you gotta figure out specifically. And the best thing to do is call our office.
Absolutely, because then we could sit there on the phone with you, or we could have you come in for an appointment, and we don't charge anything for that kind of planning either.
That's right.
But
to do a move because you called on a radio show,
yep.
There's so many twists and turns in taxes. It's really best if you give us a call. There's no obligation. Our phone number at corporate is 632-7886. We're very happy to help you. Or you can email us, and we'll email you back and forth.
Go on to egtax.com, and you can submit a tax question to us, and we'll answer it to you.
Okay, and if you want to join us here in studio, 8030930, 8030930, star 930 on a cell phone. We go all the way out to Rochester. By the way, we have a brand new Rochester office in Greece.
Let me tell you how it will be.
Prices are very low. Our supervisor there has 19 years experience, and I know you'll be very happy with our services, our fees, and we do everything everybody does for a lot less money, and we love you too.
Average fees are nearly $100 less than the other
else.
guys.
Right, that's right. All right, now I know we have people waiting. 8030930, 8030930, star 930 on a cell phone. Want to go back to some of the changes that happened last week. The PEAS limitation, which basically starts to limit itemized deduction for upper income people, that is now phasing out if you have income of $250,000 and you're single, $300 if you're filing a joint return. There you go again.
Another
you
marriage
see the penalty. Okay, exemption phase outs, same thing. $250 single, $300 married joint. Another marriage penalty. Federal and estate and gift taxes. The federal estate tax is now on everything over $5 million. We thought it was going to go to $1 million, but the rate is going to be at 40%.
Instead of what was it, 55? It was going to go to.
It was going to go to 55.
Yep.
It was 35, so they made it 40, kept it $5 million. So that's bad. Good news. It's better than it was going to be, right? And then the other thing is. Let me see what else I got. Oh, state and local sales taxes was supposed to be gone this year, and then they put it back in the law. So those of you that are seniors who don't pay New York State any taxes anymore because your pensions are excludable and you itemize, make sure you get those sales taxes together.
Or those people who bought a vehicle.
That's right.
Bought a car, you could write off the sales
tax. And the combination of the two, right? Child tax credit. We were worried that the child tax credit was going to go down to $500 for kids under the age of 17. They kept it the same, $1,000. So that's a good thing. The earned income credit has basically stayed the same, been adjusted to 3 kids or more, up to 3 kids. No.
Yeah, up to 3 kids.
Yeah, up to 3 kids.
Up to 3 kids.
Yeah,
and the rates are still relatively the same. I think they've increased a little bit.
They did increase, so the EIC is higher than ever.
Yep.
But one thing we just did in training is the due diligence requirements require that we have to list that we know the child is living in your house. So this year, when we're doing a tax return for somebody claiming an earned income credit, we have to see proof that the child lives in the house.
Whether it's a school record or a doctor record, something that shows the child's name and their address, we need to see that before we could submit the return.
That's right. Adoption credit was supposed to go down to $5,850. It's still it isn't as much as it was, but it's at $10,000, so that's good. Child and dependent care credit for daycare was supposed to go way down. They kept that the same, so that's good news. And we're going to go into some other things here after I get off the phones here with Brian in Lancaster, who's been waiting. Hey, Brian, how can I help you?
How are you today?
Good.
Good. I'm hoping you can offer me some insight. My family has been contacted by one of these companies who apparently what they do is find unclaimed funds from, deaths in the family, estates, et cetera.
Okay.
They've contacted several of my family members in hopes of getting a hold of us. Basically to say, hey, look, there's a big chunk of money out there that's been unclaimed from your great-grandmother, and there's 6 of you listed on this trust, if you will.
Okay.
Well, what I'm finding is they charge 30% of the money if we were to say, okay, go ahead, let's go through with this. Do you have any insight to offer on how we can find out where these funds are coming from? How do we find out where, this money came from in our own family?
The only thing you could do is I know New York State has a searchable area on their website where you could go into unclaimed funds. I don't remember I know if you Google New York State unclaimed funds, it'll come up for you.
Right. Have you just Googled unclaimed funds?
I have, but what seems strange is I get, how that goes in Google. You get redirected to 50 billion.
I mean, here's what I could tell you. I mean, it could be very, very difficult for you to find certain things on your own. What you may want to do, though, is rather than using one of their attorneys, maybe go out and use your own attorney and price it out a little bit and, explain to them, look, I know what's out there. If you find it for me, what would you charge? Do a little bit of price shopping. And then from there, as for taxability goes, it depends on what you're getting out of it. And then depending on that, if it's capital gains like a stock or something like that, that would be a different rate. If it's like lost wages, that would be at your ordinary rate. I mean, there's so many factors.
Or it just could be grandma's money.
Yep.
So if it's just a bank account you're inheriting, it would be completely tax-free. So
And that's the understanding that we're under there. I guess there's an estate plus over $100,000 sitting in an account somewhere.
Well, I mean, I think what Steve suggested was a great suggestion. I would go to my own attorney, see if they can't help you to find this out. But obviously, if you can't get it any other way, $30,000 and making you have 70 is better than nothing.
Yep.
Oh, absolutely, and I don't disagree with that. I just thought maybe and you guys have offered great insight, so I'll try that out. And when it comes time to paying the taxes, once we've recovered these funds, I'll come and see you guys.
All right. Well, and it just may be that you won't owe any taxes at all. So once you find out what it is, pardon me?
I said, wouldn't that be wonderful?
It would be wonderful. Happy New Year, Brian.
Thank you.
Bye-bye. I'm Esther Gullius, the tax lady from EG Tax, and yes, we are on at the wrong time because now it's the right time. We're now on from 3 to 4 every Saturday, so kind of get your game faces on and tune in. Of course, you're probably listening to the financial guys anyway, but we're here from 3 to 4 every Saturday, offering great tax help from EG Tax. So 8030930 is our phone number here in studio, star 930 on a cell phone, and I'm going to go to Rich in Cheektowaga. Hey, Rich.
Hello, Esther.
Hey.
Yeah, I wonder if you could help me here. I'm thinking about, I have a multiple unit double in Cheektowaga.
Sure.
And I'm thinking about selling that this year, and I'm just wondering what I've owned it for 35 years, and I'm wondering what exactly I would be paying on that.
Okay, what will you sell it for? Give me a good...
Somewhere around $100,000.
All right, with a realtor or without?
Probably without.
All right, so if you netted 100, you probably, I'm assuming, have you done any large capital improvements lately?
I've done a couple things that we've been claiming over the years.
All right, but lately, I'm talking like $10,000 new windows or new roof in the last 10 years?
I had put, windows and a roof might be about 10 years old. The windows are maybe 5 years old.
Okay, so let's just say that what hasn't been depreciated, because everything that's been depreciated brings that cost basis down. So let's say you have $10,000 left. Yep. Against a $100,000 sale means you're going to have a $90,000 gain. All right? And is your income over $400,000?
No, it's about 60.
And 250.
All right, so actually you're going to pay at 15%. You're going to pay anywhere from 0 to 15% on the gain of that house. So it's not going to hit you too bad at all. Actually, the state of New York is going to tax you about the same as so about $13,500 on the federal, and then the state of New York about $7,000. So about $20,000.
Okay. Oh, so it would be about $20,000 altogether. Okay.
Okay. Thanks a lot.
Yeah.
I'm Esther Gullius, the tax lady. We're going to break for news. We'll see you on the other side.
It's 3:30 from the WBEN Newsroom. I'm Eric Reinhardt. Both the NHL and the Players Union have reconvened for more talks in New York City this afternoon. As the lockout reaches its 112th day, reporters following the NHL labor talks say sources have indicated the federal mediator involved has made progress on several issues with both sides. Buffalo police are investigating an overnight shooting along the 100 block of Delaware Avenue. One man was shot following a dispute outside King's Court restaurant. A bullet also grazed a security guard who was trying to break up the argument. Both were taken to ECMC, and the security guard has since been released. Any information, call the police tip line at 847-2255. That's 847-2255. Authorities say 4 people are dead, including the suspect gunman, after a police standoff at a townhouse in Aurora, Colorado. Violence put that community on the national spotlight nearly 6 months ago after a gunman's bloody rampage. James Holmes inside a movie theater in Aurora, again, that left 12 people dead in that deadly shooting in Aurora back in July of last year. Accurate weather forecast for this afternoon. Clouds and some breaks of sunshine. More clouds than sunshine for the most part this afternoon. The high near 32 degrees. For tonight, look for a cloudy sky. Maybe some flurries down to 28. On Sunday, still cloudy with a chance of snow and a high in the upper 30s. For Monday, A mix of clouds and sunshine one more time, and a high of 30 degrees. Right now, again, a cloudy sky and about 33 degrees in Buffalo at this hour. And a reminder, you can check out the all-new WBEN mobile website on your smartphone at WBEN.com. I'm Eric Reinhardt, News Radio 930 AM and 107.7 FM, WBEN.
Listen to WBEN anytime, anywhere. Online at WBEN.com, with our app on your phone, and now on TuneIn.com. News Radio 930 AM and 107.7 FM, WBEN.
At EG Tax, we know you're on a budget. That's why we're bringing back our free simple federal return program. All you pay is just a small fee for your state, and your federal return is free and guaranteed. It's just another reason to come join our family this year. Taxpayers required to file both federal and state returns to apply. Promotion ends February 28, 2013, and applies to Form 1040 EZ only. Additional fees apply if customer receives EIC, requires additional schedules, or applies for a bank product. See egtax.com for complete details.
EG Tax. Let me tell you how it will be. There's one for you, 19 for me.
'Cause I'm the tax lady.
Oh, gee. We've never ever come back from bump music.
Lady. Anyway, I'm Esther Gullius from EG Tax, and it is tax season, and I am the tax lady, and I'm joined in studio with Steve Jacobson, and Chris and Tiffany are doing our training right now. So we are on now from, for those of you that just joined us, from 3 to 4. So you can call in a whole hour and ask all your tax questions on Saturdays at WBEN, and we're here to help you.
You know, I got to say, we never came back to music before, and this is the first time I've heard you sing on the air. Could this be a regular weekly thing with you?
If he plays the tax man. Okay, and we're going to go back to the phones. I know we've had Bill from Rochester holding a long time. Hey, Bill, thanks for waiting. How can we help you?
Good afternoon and Happy New Year to you.
Thank you. You too.
Question. My wife and I both have IRAs, approximately $90,000 in each.
Okay.
And she'll be retiring this year, so we won't have the normal level of income going forward. And I just wanted to know the arithmetic steps to calculate an incremental conversion from a traditional to a Roth without triggering or pushing ourselves into the next bracket.
Okay, so
how do you do
that? You really have. All right, so you realize you're going to pay taxes.
Yes,
okay.
I understand that, but I don't. What I don't want to do
but I
is
can't
pay taxes at a higher rate.
I understand. So, are you both retiring this year, or only one?
Both.
Both, and you're going to have pensions, right?
One of us has a pension, and then at age 62, we'll start Social Security.
Okay, so when is everybody retired? What month?
July this year.
All right, so you got a half a year of you're going to have your regular income. I'm assuming it's going to be, how much is a half year's wages?
Probably about 50, 60.
Okay, so for sure you'd be in the 15% tax bracket right now. So what you really need to do is assume, I would probably look at what you could get away with at 15% through this year, but remember it's taxable income. So you're going to, okay, so it's you're going to take a look at the tax rate schedules, and you're going to compute out what your taxable income is going to be, your projected taxable income, and then you can take all that money and roll it over from your traditional IRA to a Roth at that rate.
So mind you, after your standard deductions and personal exemptions, if your income is under $72,500, you'll remain in that 15%
All right, remember,
bracket.
It's not income, it's taxable income.
After standard
deductions. And so you're going to do that. Then the next year, if you want to do it in the 10% bracket, you have to or 15% bracket, you got to take a look at what your pension's going to be, and that same thing is figured for the next year. And if you do that systematically until you have that money all in the Roth, you've done it at 15%.
Okay, so what you're saying is calculate your normal taxes using the current tax tables.
No, actually calculate your taxable income.
Yep.
After your deductions.
After your deductions and exemptions.
Then you look at how much room you have at that taxable income rate to the top of the 15% bracket, and that's how much you can take out at 15% in 2013.
Okay. And then
then next year you do the same thing.
Okay, great. Thank you.
Okay, thank you, Bill.
Bye.
Bye-bye.
And mind you, that that 72.5 that I was saying, that's actually 2012's rates. I mean, I would assume it would go up a little bit for inflation.
For next year, yeah. And there'll be a little more personal exemptions and all that kind of stuff. But that's basically what you do. If you want to stay in that tax bracket, you just basically figure out what your taxable income is going to be without it, and then the difference between that and that tax rate at percentage is what you would take out.
And if you're in a situation like Bill's, I mean, there's a lot of complex stuff with that. But if you want to call our office or stop by with all your documentation, we can look it over and give you a more exact figure.
And then the other thing is, let's say he's off by $1,000. So everything over that 15% is going to be taxed at the next level, but only that $1,000.
Right.
So if he went from 15 to 25. So he's going to be $250 on the next $1,000. So it's not like the end of the world.
Yeah, that's what people don't really realize. We have a graduated income tax system. So what that means is it starts off where all your income up to a certain threshold is 10%. Then the overage is at 15, and then if you go over that.
So if you are over that little bit you're over is at the higher tax bracket. So it's not the end of the world. I'm Esther Gulius, the tax lady from EG Tax. Our phone number here in studio is 8030930, 8030930, star 930 on a cell phone. And Tammy from Buffalo has been waiting. Hi, Tam.
Hi, how are you?
Good. How can we help you?
I have a grandson who lives with us. He's a minor, and he is currently collecting on SSI.
Okay.
And my question is two-part. One, can we still claim him as a dependent? And two, do we have to fill out a separate tax? Does he have to fill out his own taxes?
Okay, well, first of all, for SSI, no, he does not have to fill out his own separate thing. That was
his only income,
That would
right?
be his only income, so no, you wouldn't have to worry about that as long as that was his only income, correct?
He also had child support that came in, but it was a small amount.
Okay, well, child support is not taxable. So if that was his only income, the child support and the SSI, you're in the clear. Now, for the other part of can you claim him, the only thing that you would have to factor in is as long as you provided more than 50% of his support, so you'd have to look at how much money he brought in from the SSI and the child support, and then if you paid more than those things combined, which you probably did, then you could claim him as a dependent.
How much is he getting in Social Security?
This year he got about $8,000.
All right, and how much is the child support?
$25 a month, but they weren't paying very well.
All right, so how many people live in the household?
3.
All right, so yourself, your husband, and your grandson, right?
Correct.
So when you calculate out your total fair market rental of your home, your utilities, your telephone, your cable, your food, and you come up with 1/3 of it is what you contributed towards your grandson's support, plus his total support. If you gave more than 50% of let's say $8,500, then you'd be able to claim him because he's not giving over 50% to his own support. And now, how old is he, Tammy? That's the other thing. He's 3.
Yeah.
Aw, that must be wonderful to have your grandson with you. That's 3.
He's awesome.
Oh, that's great. Yeah. So, and then the other thing is you get the child tax credit, which is going to save you $1,000. So you're going to get the dependency deduction, and you're going to get the child tax credit. So those will really help you out. And you'll also get it on the state of New York. So, okay?
Beautiful. Thank you so much. I appreciate it.
All right. Bye-bye.
You know, and we see a lot of those situations too, not just with children receiving Social Security, but also, parents and grandparents who are living with other people as well. And the one thing that you also have to factor in, which it wouldn't really apply to a 3-year-old, but what's the person doing with the money? If they're just putting it in the bank account, they're not really using that towards their support at that point. So then that money wouldn't even come into play.
That's true.
And
that would be something for her to think about as well.
Yeah.
I'm Esther Gulius, the tax lady. 8030930 is our phone number here in studio. Star 930 on a cell phone. Love to talk to you about taxes. We've been talking about the American Taxpayer Relief Act that was passed last week, and we're going to continue with that. I know we have people holding, but give us a jingle. We'll be happy to talk to you about your situation. Another thing that is extended is the American Opportunity Tax Credit, which is an education credit. And I will tell you, the education credit form this year is 2 pages long and asks for all kinds of information. And depending upon the information you put on that form, it looks to me like they may audit you if you don't wait for the 1098-T.
That's right, because they want to verify that you are actually putting legitimate figures on the form. Now, that doesn't mean if the 1098-T comes out and it's incorrect, because a lot of schools go on fiscal years,
right,
that you can't put in a different amount, but just make sure you have that documentation backed up, because you will probably get a letter. And I'd also like to say something else, too. It's a minimum of 2 pages, but for each child you're claiming it for, there's an additional
another one.
Page.
Right. So the American Opportunity Tax Credit is up to a $2,500 savings. It is in the law. It has been extended. It's much more complicated this year to get it. And they are asking for information that's only found on the 1098-T. So you may want to wait to file your return until you get those 1098-Ts, because you certainly don't want to get a love letter from the IRS in the summer.
Yep. And something else with education, teachers will be happy about this, that wonderful little $250 expense that you could take above the line, and above the line means not itemizing, just as an adjustment to income, that's back in the game. And
right.
And that's a big deal.
And that was supposed to go away. And so they took in things that actually they'd cut out, and they put them back in.
And student loans, too.
And student loans up to $2,500 in interest. They were going to make it only for the first year of 5 years of continuing payment of your student loan interest. That's been put back in. Let's see. The MIP, mortgage insurance premiums, still deductible.
I'm a happy man for that one, let me tell you.
Right. And then for you, we talked about the IRA distributions to charity, that you can still roll over up to $100,000 to your charity. And you can do it up till February the 1st, because they told us that you couldn't, and they put it in the law. So if you want if you want to take advantage of that and have it not be taxable, you can do it up till February the 1st. And for 2013, it's still deductible for the whole year if
Absolutely.
you wanted to do that. Okay, well, I've made Joan wait a long time. 8030930, 8030930, star 930 on the cell phone, and I'm going to go to Joan in West Seneca. Hey, Joan, thank you for your patience.
Hi, how are you?
Good.
Well, I'd like to ask you something. We have a 24-year-old son that we have claimed on our income tax. So he fell under the Obamacare, where he can be fully covered his medical insurance under my husband's policy. Now we're finding out that we can no longer keep him on because our insurance company has grandfathered themselves into an older plan that he will no longer be covered at all. Does that make sense to you?
I have no idea about your insurance company. I can only tell you that under the Obamacare, that children were supposed to be able to be covered up to age 25. Yeah. So I don't know. I guess what I would do is ask your insurance company how they can reconcile that in light of the federal law.
Has the federal law changed at all for claiming?
No.
So
no. You got to understand. It's your child that lives in your home doesn't necessarily have to be your dependent. And so this one thing is insurance, the other thing is taxes. You may not be able to claim your son as a dependent anymore in your tax return, but under Obamacare you should be able to put him on your health insurance.
We should be able to.
You should.
Saying.
Yep.
See, they're saying that we have to be able to claim him as a dependent.
Well, I'm going to tell you, children cannot be claimed as a dependent even if they're in college once they hit age 24. So that isn't the case. So I think if you would like, you could call our office on Monday, 632-7886, and I'll be very happy to download that portion of the law and send it to you so you can send it on to your insurance company.
Could I have your number, please?
Sure. 632-7886.
7886. Okay.
All right, Joan.
Can he claim his student loans when he files his income tax?
If he's paying for them, if it's his loan and he's paying for them, then he can take up to $2,500 as an adjustment. Yeah.
Okay. All right. Well, I'll phone you then on Monday, and maybe we could.
Yeah, and then we'll pull out the articles or whatever portion of the law we can find that shows that you can that he can be claimed on your health insurance. I'll either email it to you or fax it to you or mail it to you, and then you send it on to your insurance company.
Okay, I really appreciate it.
You're very welcome.
Okay, thank you.
Bye-bye. I'm Esther Gullius from EG Tax. Our phone number here in studio is 803-0930, 803-0930, star 930 on a cell phone. And we wanted to cover some of the things that changed last week in the tax law. Other things for you business owners, here's some good things. The 179 expensing stayed in effect. So you can write off for business equipment that you purchased in 2012 and 13 up to $500,000 of equipment you buy.
It was going to drop down to $25,000, I believe, which was just really, really tough on a lot of people.
Right, and a lot of the work opportunity credit stayed in place, plus a lot more of the business extender stayed in place. And for those of you that were told by us that you couldn't do the energy credits anymore, well, they put it back in.
I know.
They put it
out
back
of nowhere.
in. So the maximum you can take as an energy credit for qualified home improvements is $500 on your house lifetime. So if you've already gotten it, you can ignore me. But if you haven't and you did home improvements last year, qualified energy conservation, it's in the law for last year and this year, but it's only through 2013. It looks like they want to take it away. Now, the other thing is Obamacare, right? That came into effect in 2013. And in 2014, people have to have health insurance.
That's right. And I can tell you right now, the one thing you got to be careful of is there's a lot of things you're hearing out there, a lot of stipulations, and truth of the matter is we don't know all the details yet of how they're going to actually do everything. But what I can tell you is, and I know we've talked about this for the past couple of weeks, is starting in 2014, if you do not have health insurance, what's going to happen is there is going to be an individual penalty that you will pay. I can tell you that the max penalty for 2016 is going to be up to $2,085 per family.
And now I will tell you, if you get the penalty, doesn't mean you have insurance. You pay the penalty.
You just pay the penalty.
And any employer that has a penalty for failure to cover employees, they have to pay the penalty of $2,000 an employee if they have one,
right.
And it's not deductible.
Right. What I really thought was interesting, and I know we talked about this at training, is that for the individual penalty, if I'm Joe Schmo and I'm filing my tax return, and let's say I have an Obamacare penalty, all the IRS can do is offset my refund to pay for the penalty. They can't come after me in collection. They cannot seize my bank accounts. They can't do anything. They can't even prosecute me. So at the end of the day, if you owe money on your tax return, you just pay your tax liability, and then they can't come after you for the other money. So the question that comes to mind begs, how are they going to pay for this down the road?
No, but I mean, to me, that they'll put teeth in it. I can't believe they're not going to put teeth in it. But anyway, so starting in 2013, okay, a lot of the medical things have been stepped up. A lot of the taxes on medical appliances are in there. They were going to cut for doctors. They were going to cut Medicaid reimbursements by 27%. They have extended that for a year, so doctors aren't going to take a big hit. But the Obamacare stuff is coming into effect now. In 2014, employers with more than 50 employees, full-time equivalent employees, are going to have to provide health insurance, qualified health insurance,
correct,
to their employees.
And the way the penalty works out is if you have, and by the way, a full-time equivalent employee is the average hours of each employee averages around 30 hours or more, and that makes a full-time equivalent. Now, if you have over 50, the way to do the penalty is if you don't offer any insurance, you take the total number of full-time equivalent minus 30 times $2,000. But what really gets me is if you do offer insurance and it doesn't necessarily meet the minimum coverage, or you have and people are buying through the exchange, and let's say one of those people buying through the exchange is 400% above the poverty level, and an example of that would be if you're a family of with 5 kids or something, that's around $120,000, but the penalty is $3,000 for everybody buying through the exchange at that point.
Right, but the whole thing, and I'll tell you, a lot of people are saying, oh, but that won't affect me because I'm already covered. I'm going to tell you, as this thing rolls out and employers see what they have to pay, I think employers are going to drop coverage, and give the employees what they would have given them for health insurance. Let the employee go and buy it themselves, okay? And then the employee may get a refundable credit, because that's the second part of the thing. There's the part that you have to say to the IRS, the federal government, yes, I have health insurance. This is who I have it with. I've had it for most of the year, except for maybe they call it short absences, less than 3 months. And so you would pay a penalty or not pay a penalty. And if you do have health insurance, and if your income is under 400% of poverty level based upon your family size, you get a refundable credit for paying your health insurance. So actually employees may make out, but you may not have the health insurance that you thought you're going to have.
And I really thought it was interesting, too, that they did say this refundable credit. They say the average household's going to get about $5,000 of this refundable credit.
Right.
Big deal.
Right. It really is. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone, and I've made Katie wait a long time. Hey, Katie, how can I help you? Hello, Katie.
My question is, my son is 25. He's in law school, hasn't worked at all. My husband and I have been supporting him.
Yep.
Can we claim him on our tax return?
All right, so Katie has no source of income.
None at all.
All right, yes, you can claim him. Now, this is what the law says. A kid under age 19, regardless of income, unless he's supporting himself, you can claim. A kid 19 up to 24 who's a full-time college student, regardless of income, and he's not supporting himself, you can claim him. Once a kid hits age 24, or anybody living in your house once your kid hits 24, you can't claim him regardless of income. He would have an income restriction. But since your son doesn't have any income, that's set aside. And if you gave over 50% of his support, he's not married and filing a joint return, he's a resident of the United States or citizen of the United States, and he lives in your home, he can be your dependent.
Awesome. Thank you very much for your time.
All right. Thanks, Katie. Bye-bye. So, I mean, and that's what's so interesting. You know, those qualifying children, it would be the kid that's up to age 24 that's in college. But once they reach age 24, they really kind of go into they leave the qualifying children category and go into qualifying relatives. Right. So it actually moved from one to the other. I'm Esther Golias, the tax lady. Our phone number here in studio is 8030930, 8030930, star 930 on a cell phone. Stevie, anything else on Obamacare that you want to talk about today?
I mean, I also want to say, too, is when, for employers, there is a health care credit. So if you are paying for the insurance, even after Obamacare goes into effect, starting in 2014, that credit goes up to 50% of the premiums that you pay, so long as there are all these restrictions.
Right.
And
well,
stuff,
you can't have more than 25 employees.
Yep. And
the average employee can't make more than $50,000, and it can't be your relatives.
And you have to pay more than 50% of
their
coverage.
Insurance. Right.
And that's why I want to make this point, because a lot of employers are out there thinking, well, I'm just going to pay the penalty because it's going to save me so much more money to do that. Well, stop and hold on for a second, because first of all, that penalty is not deductible.
That's true.
So you're not going to save any money on that penalty. And furthermore, the credit versus the expense of the Obamacare penalty, it might work out better to go on the credit side. It all depends. Insurance rates are kind of weird.
I mean, when you think about, let's say an individual employee maybe being $700 a month, right? So that's $8,400 versus $2,000.
Right.
Even though you can't deduct it, it still looks pretty good. So, all right. I'm Esther Golias, the tax lady from EG Tax. All of our offices open on January the 16th. On the 21st is the first day of electronic
22nd.
First day of electronic filing. And we're here all tax season and all year from our new time from 3 to 4. And if you have any questions during the week, you can join us at 632-7886 at our corporate office or on our website at egtax.com.
Absolutely.
Okay, we're going to go to Ron in Williamsville. Hey, Ron. Hello, Ron.
Good afternoon, Esther. My question is regarding an opportunity I have to set up an LLC.
Okay.
Mm-hmm.
And I understand the LLC is not recognized by the IRS, but I do have an opportunity to opt on either a sole proprietorship or an S Corp or a partnership.
Well, I don't know what I mean, an LLC is recognized by the Internal Revenue Service. I don't understand what you mean.
Oh, I was reading on the internet it was not.
No, I mean a limited liability company is treated as if it's a sole proprietorship, all right? And so it's filed on a Schedule C, okay? But it's still given sanctioned by the state of New York, and so the IRS does recognize it.
Okay, but what is this Form 8832 that they reference where I can elect to treat myself?
Oh, yeah.
Okay.
Yeah, so the 8832 is the election to move from, if you're an LLC, to a subchapter S, or depending upon, or if you have a partner and you want to go and become a full corporation, a C corp. So that's where you make your election to move from one entity to another.
And keep in mind that's tax treatment only. That's
right.
The most important thing. It does not necessarily mean.
My concern is that I think my single largest deduction will be a contribution to a retirement fund for myself.
Okay.
Well, what do you mean? How can that be? What kind of business do you have, Ron?
Consulting.
All right, so you have a consulting business, and you think that you're going to use this vehicle to set up a pension plan?
Yes.
Okay, so, geez, we don't have time to do this over the radio, but basically, when you're an employee, okay, on the LLC as on the Schedule C, you could have made a contribution to a simple or a KEO through your Schedule C. But if you move to an 1120 or 1120S, you have to pay yourself wages. In your wages, then the company can set up a pension plan. So it becomes more complicated. What I'd suggest you do is call us at the office so we can give you the ins and outs before you go ahead and shoot yourself in the foot, if you know what I mean.
I appreciate that.
All right, so call us at the office on Monday, and we'll walk you through it, okay?
I appreciate that.
All right, thanks, Ron. Happy New Year. Okay, and we're going to go to Scott in Lancaster. Hey, Scott.
How are you?
Good.
Just a couple of quick comments. You were talking about the look-back period under the Obamacare, and it is so confusing for the employers. There's no single website that you can really go to and get all the answers. And to give you an example, I even called the U.S. Department of Labor, who is supposed to have all the answers for this.
Okay, but you know what? Steve just came back from an Obamacare seminar, and he does have the goods. So what I'd suggest you do is that you call the office on Monday, and we have a big pamphlet we can send you, which is the best information that we have been able to find that'll help you as an employer to figure out what to do with Obamacare.
I will do that. I appreciate that very much.
All right, thank you. And we're going to go to Ivy in Amherst. Hey, Ivy, we got to do it quickly. How can we help you?
Oh, fine, thank you. I just wanted to find out about emancipation. I have a 17-year-old, and eventually he'll be going to college, and I wanted to know how does that work if I wanted to have him emancipated.
Okay, well, you know what? Hang on. I'm going to talk to you and Marge off the air because I ran out of time, okay? I'm Esther Gullius, the tax lady. If you need the best tax help for the most reasonable fees, EG Tax is open on January the 16th at all our branch offices. If you need us during the week, egtax.com. Until next Saturday at 3 o'clock, I'm Esther Gullius, the tax lady, with Steve Jacobson. Bye-bye.
You've been listening to Ask the Tax Lady with Esther Gullius and EG Tax. To reach Esther at her office, call 632-7886 or go online at egtax.com.